I don't think it's all about money. It's the internet of value. That's why Web3 has become the narrative. So Bitcoin is a different beast and it's more of a reserve asset. Does it turn into a fully fledged medium of exchange and currency? Yeah, but that's not happening for 20 years. It's possible. I doubt it because governments want to own their supply of money. They want their own tokens for their own community, like everybody else is going to have tokens for their community. But, I think as a reserve asset, Bitcoin works. But what we're actually talking about is the way of storing, transferring, and recording ownership and value in the digital age. Governments are not going to get in the way of that, and they just want to make sure it's regulated a bit.
We have a bunch of government working groups writing reports, but it's the signal that it sends about some of the things, some of the wording we heard in that, talking about the future of money, talking about U.S. remaining competitive by being involved in these digital assets. Really interesting language.
Yeah, and I also thought they remember I've had a few rants about the fact that the SEC was trying to stop people participating in this. It felt inclusive language. And I thought that was really important, that they kind of acknowledged that this is an opportunity for the broader public and they can't not allow it. So the markets have been thrashing around trying to digest news flow, which is always why I've said be careful of trading geopolitics. But there are more structural things going on that are interesting. Obviously, equities are still in a bear market. Whether they're trying to find a low or there's something bigger, we don't know yet. My thought process is it's probably more likely to be getting closer to a low. But if we start playing out the full recession card, which the yield curve doesn't yet suggest, then, okay, that could be different. So I'm looking at that. I'm looking at the dollar. I'm looking at the bond market, looking at gold, looking at crypto. So there's a lot of things to look at. People are now talking about a structural shift in inflation. Is it possible? For sure. I still think the probability lies in the chart of truth. Everyone's screaming inflation, but I think of the inflation at 8% as a massive tightening of monetary conditions because neither corporations nor people can offset it with increase in earnings or cost rises, price rises. So what you've got is a tightening of monetary conditions, particularly on lower and middle income households, because the earnings gap is massive between wage growth and the inflation numbers. And that tends to slow growth. And we're seeing forward-looking indicators suggest that growth is slowing down quite fast. And that will play out not immediately, but in the next 6 months. So I'm looking at this thinking, could everybody be kind of wrong? So if anybody had ever told you 10 years ago that inflation was going to be at 8% and bond yields were going to be sub 2, they'd have laughed in your face.
Yeah.
So it tells you there's something people don't fully understand about this.
Yeah.
And it's about the forward inflation expectations driven by demographics and a debt super cycle. So my view is higher inflation is disinflationary, forward looking. And the bond market is telling you something similar. So the most risk averse asset in the world is the US bond market and the US dollar. We've seen the dollar scream higher because of this. So everybody's record underweight pretty much the bond market. So therefore money comes into the bond market. And we've seen those kind of moves in stuff like 9/11 and others where, those kind of events move bond yields. Okay, let's assume the other side. Let's assume that there's a truce that gets called tomorrow. Well, we're going to see crude oil down significantly, et cetera, as people start to think, well, the Europeans will cut a deal and they'll be able to get oil and gas and commodity prices will flow, in which case those things turn around, and in which case the inflation pressures come off, bond yields fall. So I kind of feel like we're in a sweet spot, unless I'm going to be wrong. We can see where I'm wrong on that chart, roughly speaking. And that would be if there is a structural change in the entire bond market dynamics. Now, in 10-year bond yield terms, could it get to 225 and still be in the chart of truth? Yeah, fine. So, but it kind of feels like we should be looking for the change. So what's weird this time around, it's kind of peaked really early, which plays into the argument that I'm having that monetary conditions are actually, the inflation is actually essentially like rising interest rates 200 basis points already. So once the Fed starts to rise, so these are the last two rate rises, and the yield curve is in orange. The yield curve flattens as soon as they start rising. So we're currently today 25 basis points from a yield curve going to zero. So I can't see how you can get interest rates to rise more than 50 or 75 basis points before you've actually created a recession. So that makes you think that if that's the case, that the forward-looking indicators suggest that there's going to be a potential recession ahead, then normally demand destruction comes. Along with the rise in prices causes demand destruction. The answer to higher prices is higher prices, is an old commodity market saying. So therefore, bond yields should come off. Essentially, the Chinese never report recession, but essentially the Chinese economy's been in recession. It's actually leads the US economy by a year, so we should expect a similar outcome. So there's that. Then foreigners do not want to own Chinese assets because of what's just happened to Russia. So the extrapolation is ... China ... Taiwan, let me sell all my stuff because I don't want to get sanctioned and it being down 90% or frozen. So that's what's going on.
You know, I was actually thinking about this earlier. It's like the Tony Greer trade and the Cathie Wood trade. I think they may both be right, just on different time horizons.
That's always the case. That's why I find it ridiculous that people insult each other for, you know, I'm a commodity person, that's a tech person, those guys are idiots. It all works in the right way at the right time. You know, I've been waiting to buy these blown up tech stocks ever since I talked about the exponential age thesis. I've not bought any of them yet because they were 2 standard deviations overbought versus the log trend. And I've been waiting to get to 1 or 2 standard deviations oversold. And lo and behold, that's where we are now. So I'm kind of looking at them very actively and looking for a change in the macro to buy them. That's how to build a macro framework. You have the secular trend, the cyclical trend, and then where we are now, where you start using technical analysis. That's how I've always approached markets, because I tend not to like to trade against the secular trend. So I'm almost never short bonds until we prove that the secular trend has changed. The key takeaways is this is a really complicated situation. The geopolitics are terrifying, saddening, complex. The markets themselves are caught between that, inflation, a tightening Fed, slowing growth. It's a very complicated world. This is not the time for widows and orphans. This is not the time to make big bets, because this is the time you'll get carried out. So be very careful in what you do. You know, manage your risk very carefully.